It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to another episode of the Real Estate Breakfast, talking your real estate, your property news. We do it right across 7 days, including the weekend, as heard on iHeartRadio, Spotify, Apple Podcasts and Amazon. Hope your weekend is a good one. A Sunday morning, October the 13th. And a bit of news last week that I wanted to mention is New Zealand faces a bit of a subdued economy at the moment. The Reserve Bank of New Zealand there has cut its official cash rate last week to 4.75%. Now, that is a 50 basis points reduction for the second consecutive meeting. Now, the move aims to address weak business investment, consumer spending and softening employment conditions. And with new inflation now trending downwards, the Reserve Bank in New Zealand is taking aggressive steps to stabilise the economy. Now, one of the big problems that they face at the moment in New Zealand is the brain drain out of NZ. The talent, where is it going? It's coming to Australia. And we will pick up on that talking point as we reflect back over the last 7 days, which is up next.
We are more than just a real estate podcast. Follow each week all of the main talking points and know your property.
Sydney slightly up, Canberra, Hobart and Darwin and Melbourne down in the marketplace.
Yeah, good morning. Thanks for having me. It's fair to say that we're moving through a very diverse market. We always say that Australia is not one housing market, but at the moment in particular, there's a really wide range between the top performers, Perth, Adelaide, Brisbane, and those more subdued markets that you were talking about, Melbourne, Canberra, Darwin and Hobart, which each saw quarterly declines. Sydney is still up, but I think that's because it's a market that historically has been relatively constrained when it comes to new levels of supply. At the moment, it's being driven by more affordable pockets of the market that offer house and land for a growing number of young families. And even though market values are still rising, you can even see momentum coming out of the Sydney market. As you say, that 0.5% lift was one of the softer growth rates that we've seen in the market over the past few years. It's down from 1.3% in the June quarter, and it's down from a 2.5% quarterly increase for the September quarter of last year. So at 0.5%, we can see it's definitely slowing.
Yeah, so, if you're in Sydney and you're saying, oh, gee, it's not much of a rise, it's very, very slow, just compare yourself to Canberra, Hobart and Darwin and Melbourne, which is all down, which circles us back to Perth, Adelaide and Brisbane. They saw that slower momentum, as I suggested, although they did continue to perform, and that's the positive side for those markets.
Yeah, absolutely. Anyone who has owned in Perth or Adelaide pre-pandemic has seen extraordinary cumulative change in home values. Since March of 2020, Perth's home values are up 75%, or the equivalent of a $341,000 increase in the median value. Adelaide has seen similar performance, up 69%, or an additional $330,000 added to the $330,000 added to the median value, and Brisbane sitting up 66%, or $350,000 added to the median value. So even though those growth rates are finally slowing down across these cities through the cycle, at 4.7%, Perth's quarterly growth rate is still extraordinarily strong. And at the moment, like most cities, it's probably being driven by more affordable pockets of the market at this stage because people have been priced further and further out of expensive markets.
Wow, okay. And just sort of in that lane, is it fair to say that affordability constraints and reduced borrowing capacity continues really to support stronger conditions across the housing markets with the lower price points?
Absolutely. And I mean, the irony of it is too, we talk about it being a buyer's market because prices are coming down. Part of the reason prices are coming down is because there aren't as many buyers that can participate in the market. Or where they can, they're having to target cheaper and cheaper properties because of limited borrowing capacity in the high interest rate environment and affordability constraints. So one of the ways we measure this is breaking the market up into different value chunks. If we look at the combined capital cities market, the bottom 25% of home values, which is anything about $680,000 and below, has seen a remarkable increase in value of 12% over the past year. If you look at the top 25% of the market, which is about 1.3 million and above, that has only increased about 4% over the past year. So double-digit increases across the low end of the market, and that is, again, just a reflection of more and more people having to target the lower end of the housing market because that's what they can afford, and that keeps more of a floor under values and keeps them rising more strongly at the low end.
Ready to step up your property knowledge? Access powerful insights with us.
Well, there's more work than the industry can cope with, which is a first-class problem, but the challenge is delivering it. In the last 12 months, we've had the Queensland government's budget. They have gone right out with a significant capital works budget. They'll spend $27 billion in 24-25, $107 billion over the next 4 years, and then we have the lead up to the Olympics in 2032. So there is lots and lots of work for the commercial builders. And at the same time, we have state, territory and the federal government committing to this target of 1.2 million new homes over the next 5 years. So starting at 24-25. That breaks down to 49,000 new dwellings, units and detached houses in Queensland each and every year. And thus far, we've fallen behind. So that's where we're at. We've still got issues around the cost. I think the costs, particularly of materials, still going north, but not at the same rate that it was a year ago, and certainly not a lot less than 2 years ago.
Yeah, and I remember when we spoke over 12 months ago now, it was a different planet. I mean, you were having builders going out of business. It was a pretty dire situation, I remember, 12 months ago, and that corner has been turned by the sound of it.
Well, we've still got issues with builders dealing with legacy projects, so those fixed price contracts that have put them underwater, and builders can afford to wear those losses. But at some point, the music stops and they fall over. So we've seen insolvencies. There are still some to come, I would predict. We have turned the corner, and contracts that are signed this year and maybe a bit into last year, I'm confident are profitable, whether it's the commercial projects, residential development or detached houses. Builders are making money, the trade contractors are making money, but there are still issues with insolvencies, sadly.
You mentioned that the building materials, they have gotten a little bit cheaper, but 12 months ago it was more expensive. The numbers didn't stack up. People are now looking a little bit more favourably with building. How much is that sort of saving from a year ago? What's that sort of looking like?
Well, not significant. The most recent data from the Australian Bureau of Statistics is up till July this year, and the cost of building detached housing, so a house in Queensland, has gone up 38% over the last 3 years. So almost 40%. Total construction is up around 30%. So that's the units, houses, and the commercial buildings. So we're up a third. It has come back a little bit, but still significant price rises, which is why we're facing the dilemma that we are. The developers can't make the unit developments stack up. They're just not economically viable.
Are you spending big bucks on ads that don't hit the right audience? Isn't it always about the right audience? You can land your message directly every day with our core audience. It's a powerful connection.
Now, you mentioned the city of Knox. For the listener, can you just sort of explain what that captures in terms of suburbs?
We got Rowville, Listerfield, Ferntree Gully, Baronia, Bayswater, Upper Ferntree Gully. It's quite a tight net kind of suburb, which is outperforming actually any other suburb at the moment in Melbourne. It's kind of always continuously growing. I think the buying market and the selling market is always consistent with the city of Knox and definitely outperforming any other area in Melbourne, to be honest.
Now, because you're in Melbourne, I guess we should talk a little bit about the property tax and the sentiment with investors, because some of the investors, they've decided, well, I'm going to leave the market. And you know what? Perth actually looks pretty attractive at the moment. Oddly enough, there are some transactions happening the other way from Perth investors looking in at the Melbourne market. A lack of trust with the government. How much does that play on the minds of those investors at the moment in Melbourne, do you think?
Yeah, look, it's quite enormous. I've actually spoken to a few friends that aren't even in real estate, a lot of investor friends of mine as well. Essentially, the investors have lost all trust in the Melbourne government, just with the land taxes. Everyone got hit with quite enormous land taxes, obviously, in the last couple of months, which has caused a lot of them to offload. So, for example, our office has 2,000 plus properties on our rent roll. We saw or are seeing 10% of them come to the market before the end of the year. So, yeah, we're starting to see a lot of them leave the marketplace from Melbourne and start to head towards other states such as Perth and Adelaide, which, yeah, we're seeing quite a boom actually right now.
Let's right now, Tim, have a look at the grants for first home buyers, because that is creating more of a buy-in factor from what you're seeing.
Yeah, definitely. I think with the first home buyers, you know, they're starting to be able to borrow up to around 975,000. What we're seeing is, I think the increase in first home buyers, definitely under that $1 million mark, is where we're starting to see majority of buyers enter the market, especially if it's close to that 700,000 to 800,000. Once you start to go above that $1 million mark, we lose a lot of the buyers, because now we're starting to incorporate people who are having to borrow a lot more money, which is capping a lot of those buyers to enter the market.
Now, just in the last week or so, we've done podcasts in the likes of Rockhampton, also Darwin, talking about their median house price, $500-600, 800 square metres. And they're talking about interstaters moving from the likes of Melbourne. Are you sort of seeing that firsthand, people moving out of the area?
Yeah, we definitely are. I think we saw it, to be honest, after lockdowns. I think the majority, an enormous amount of people from Melbourne actually moved out to the state, to Queensland. A lot of them moved to Perth, a lot of them moved to Adelaide. So we're still seeing that now. Funnily enough, I've recently started to see a lot of people move from New Zealand to Australia now. So in the last week, I've met about 10 people who've actually decided to leave New Zealand just because it's getting a little bit too expensive now, and they're moving to Melbourne. So we're seeing a shift out, but we're also seeing a shift in from certain directions.
Well, that is interesting, because I can tell you anecdotally, something that we have noticed here at the podcast is the amount of New Zealanders following us now. And that was something that we never really used to see, particularly over the last 4 to 6 months. More and more Kiwis listening to the Real Estate Breakfast. And if you are in New Zealand, good morning to you.
Yeah, and that doesn't actually surprise me due to the inquiries that we're receiving and people from New Zealand that I'm meeting at open homes as well. So, yeah, it's something we're definitely seeing.
You know, the other thing too with landlords, this just does my head in. I just can never fathom why landlords are not doing proper due diligence around giving their properties or property to a manager to look after. It's just crazy stuff. They don't really do what they need to do.
I think there's a lack of understanding amongst property investors as to the difference that a proactive property manager can make to their experience of owning that property, but also the value over time. And they say, well, I'm going to compare on fees. And I guess that comes back to the property managers who do provide that higher level of service to be able to communicate how that actually manifests. You know, for example, one extra week that your property sits on the market without being rented out because they haven't got the rent right, or they haven't got the pitch right, or they haven't got the marketing out on time, or whatever it is that they haven't done, where opportunity has been missed, one extra week can erode that extra small percentage difference in fee almost immediately. And so, I think owners have to actually start looking at the whole picture there of what a property manager adds to their investment, and look at the cost as an investment itself, if you like, rather than purely just a cost. And if they look at it just as a cost, they're going to try and chase the cheapest fee. But if they actually understand that property manager that they choose can really add value to them, then they're going to look at the fees very differently.
Landlords are shopping around for the cheapest rates out there. I'll get you to talk to that. And I also want to sort of circle back to why the due diligence isn't being done. And perhaps if you're a landlord, write down 5 things that you want your property manager to do for your property. Write them down and then ask them in person. Say, what about this question, and this question? But we'll get to that in just a moment. The dangers of shopping around for the cheapest rate. There are those legitimate fears, aren't there?
We talk to a lot of people that have been property investors for a long time across the whole country, and it's really interesting the wide range of stories that we will get in terms of the experience people have had with different property managers. Some are amazing, some are absolutely magnificent, and others are just mortifying. Only today I heard a story about a property. This is an absentee landlord, i.e. the landlord lives in one city and this property is in another city. And the tenants had vacated earlier than their vacate date, and they left the garage door open. And another agent in the area actually rang the owner to say, look, the garage door on your rental property is open and it appears that the tenants have vacated. Now, her own property manager didn't know that they'd moved out. And when she said to the property manager, can you please go to the property and close the garage door because people can access the house directly through the garage, the property manager refused.
Oh.
So that's the sort of attention you get. Now, this is also, the feedback from the owner who was telling me this story was like, we've had a revolving door of property managers. They don't seem to care. The business has recently grown quite exponentially. And so from the landlord's perspective, she as literally as a plane ride away. She can't even get to her own property to close the door. And I mean, that's maybe an extreme circumstance, but it's typical of if you don't actually take the time to go with an agency that will commit to serving you and providing abundant service.
We connect you to the best real estate information across Australia. The Real Estate Podcast.